Hi, class, and welcome to Chapter 16 Mutual Fund Fees and Services. As always, I can't stress enough, please read the entire chapter. In this lecture, am simply providing an overview and going into some of the details of some of the more important topics within the chapter that I feel will be testable. But as I am not the person writing the exam, everything within that textbook and in the chapter is testable on the final exam. So let's get started. So, chapter overview: understanding the costs and features of a mutual fund is critical to providing suitable advice. This chapter covers four key areas. It covers fees and charges, the various costs associated with investing in mutual funds, accumulation plans, services that help clients invest money on a regular basis, systematic withdrawal plans, services that provide clients with regular income, and tax implications, how mutual fund ownership is taxed in non-registered accounts. So, when it comes to fees paid by the investors, I'm going to move back and forth here. There are sales fees, and then there are ongoing fees. So the first part is a sales fee, which may get or typically would get paid by an investor to an advisor for simply the initial sale of a product. Now, this is kind of the old way our industry used to work to pay advisors like myself for selling products. They would be a front end load or an acquisition fee. Front end meaning at the beginning of a purchase, there would be a sales charged to the client that would then be paid to the advisor for selling. So this is a sales charge paid by the investor at the time of purchase. For example, a 4% front end load on $1,000 investment means $40 is paid as a commission and $960 is invested into the fund. Again, this is the old method of payment to advisors, a upfront commission paid by a client to an advisor for selling a mutual fund. Typically, what are used nowadays are front-end load zeros, meaning that they are still considered a front-end load, but the actual commission charged to a client is 0%. It also typically means that as an advisor, I am getting 0% upfront for the sale of this product. Payments that I will get, we'll talk about a little bit later, but they'll come in the form of ongoing payments. The second type, or more common type, I guess, of sales commission to a mutual fund, which are typically what are sold through the retail banks of the big five, would be no load funds, meaning the funds do not have a direct sales charge at the time of purchase. However, they still have management fees that are ongoing operating costs. Other direct fees like transfers and account closing fees may also apply, but there is no load. No load would be kind of the same as calling something a 0% front end. There is simply no commission paid upfront to an advisor. The second type of fees paid now are ongoing fees that are continually charged year after year, month after month, and have more to do with the ongoing operation of a mutual fund. The first would be management fees. These are paid by the fund to the fund manager for professional investment advisory services. This is the largest single expense and varies by fund. For example, equity funds have a higher fee than money market funds because more work is involved by a fund manager to operate. Thus, they will get more in salary or fees paid to them. The second part of ongoing is operating expenses. These are the day-to-day costs of running the fund, including legal, audit, custodial, administrative fees. These are paid by the fund, not directly by the investor. The main fee to know to a mutual fund that we typically compare from one to another is the MER. We've talked about it before, the management expense ratio. It is listed as a percent, so easy to compare one mutual fund to another from a fee standpoint. The MER is the most important cost to understand. It bundles all of the management and operating expenses together into a single annual percentage. It does not matter if a mutual fund is increasing or decreasing, the market is going up or going down. The percent is charged based on the value of that mutual fund. So MER is management fees plus operating expenses divided by average net assets. It's paid by the fund automatically and reduces the fund's return. Its reported performance for a fund is after the MER has been deducted. So if you were looking at a fund fact sheet and doing a deep dive into a mutual fund to find out what its rate of returns are, those returns always have to be reported after the MER has already been charged so that a client or an advisor can simply look at the advertised rate of return and know that is what an investor would get should they invest or had they invested in the mutual fund over that period of time you're looking at. MER does not include any sales charges or loads that we talked about in the previous screens. The upfront charge, that is not included in management expense ratio if there is one. Trailer fees are paid by the manager out of the management fee. So trailer fee is typically the fee that is part of the MER that is paid to the broker of record or the advisor or the broker that the advisor is employed by. It's the portion of the MER that goes to cover an advisor's ongoing servicing and advice to a client who holds a mutual fund. So if we think of MER, typically it would cover the costs of physically operating the mutual fund, as well as the costs associated paying for an advisor to offer advice and ongoing servicing. There are costs that would be considered explicit costs and costs that would be considered implicit costs. And what do we mean by that? Explicit costs are the ones that are disclosed. These are all of the costs disclosed in the fund facts document. They include MER, management fees, and operating expenses, as well as any sales charges paid by the investor. Implicit costs or embedded costs, these are costs like trading costs, brokerage commissions. The fund pays for these when it buys and sells securities within the mutual fund, but these costs are not part of an MER and not necessarily disclosed because different mutual funds may have different amounts of trades happening at different times and different amounts in different years. So that's why when we look at mutual funds, sometimes we will talk about turnover rate. Turnover rate is the amount that a mutual fund manager is buying and selling securities within the mutual fund. A higher turnover rate typically would mean a higher amount of trading costs, which would then be eating into the returns to an investor. But these types of costs, because they are unknown ahead of time and may increase and decrease over the years, they are not explicit. They're not disclosed. They're simply embedded, they happen, and they will reduce the returns of a mutual fund. Section 2 of this chapter is accumulation plans. Accumulation plans are also known as pre-authorized contributions, or PACs, as we know it in our industries. These allow clients to make automatic, periodic purchases directly of mutual fund units. So instead of investing into a mutual fund at one specific time for one large amount, PACs, or pre-authorized contributions, allow clients to either weekly or monthly or bi-weekly or quarterly automatically buy into a mutual fund. We see this quite often when people are saving for retirement into an RSP account. They might set up pre-authorized contributions to automatically come out of their bank account on paydays and be contributed automatically into a mutual fund inside of an RSP account. What are the benefits of these accumulation plans or PACs? Well, it creates investment discipline. It forces a client to save regularly and removes the temptation to time the market. If you think about the way people budget, typically budgeting without any type of plan means what is in my bank account gets spent. That's kind of the average person's budgeting mindset. By using a pre-authorized contribution plan or a PAC, it forces a client, an investor, to invest regularly and invest constantly without having the mindset of having to remember to do it, or to actually have or save up funds on their own and letting it accumulate and then making a larger purchase. They happen automatically, and they typically happen in smaller increments. This allows for what's called dollar cost averaging. By investing a fixed dollar amount each month, the client automatically buys more units when the price is low and fewer units when the price is high. Over time, this can lead to a lower average cost per unit. If you think, some of the ways we describe it as is that when the market is declining and you're doing these PAC plans, these pre-authorized contribution plans, you're buying as the stock or the mutual fund is going down in value and becoming more on sale. The typical mentality of investing is people tend to want to invest when things are high and increasing, whereas investors actually make their money when they're buying in when things are declining, because they're buying in at lower prices, which allows the stock or mutual fund the ability to increase at a later date. That's how investing actually works, even though the mentality behind it doesn't seem to warrant it. So dollar cost averaging is accomplished by doing these PAC plans, meaning that sometimes you'll be buying at a low point, sometimes you'll be buying at a high point, but that price that you're getting in at for a mutual fund or stock averages itself out. Systematic withdrawal plans are basically the opposite of a PAC or a pre-authorized contribution. Pre-authorized contributions is putting money into a plan or a mutual fund. Systematic withdrawal plans is money coming out of a mutual fund or an account. There are different types of systematic withdrawal plans. The first is fixed dollar amount. The client receives a fixed amount, for example, $500 every month or quarter, or possibly every week or 2 weeks. This is the most common type of systematic withdrawal plan. If payments are higher than the fund earnings, the client's original capital is being eroded. So, for example, if a client has a mutual fund that on a monthly basis earns an interest of $400, yet the client has a $500 withdrawal plan set up for a mutual fund, because you were withdrawing $100 more than is being generated within the mutual fund, you will eventually start to erode the initial deposit that you put into the mutual fund. If, on the other hand, you had a systematic withdrawal plan of $500 to a mutual fund that was actually creating $600 or $700 a month in interest or in returns, you would not be eating into your original capital, and your investment would actually increase even though you have an amount being withdrawn every month. The next plan is considered a ratio withdrawal plan. Not as popular, not as normal as using a fixed dollar amount. The client in this type of a plan receives a fixed percentage of the fund's value. For example, 5% annually might come out of a mutual fund. The dollar amount received will fluctuate each year dependent on the value of the overall fund. So instead of a fixed amount, you get a fixed percentage coming out. But as we all know, the market and mutual funds will rise and fall in value. So by having a fixed percentage, you will always have a different, or typically have a different amount constantly coming out of your mutual fund. Two other types of withdrawal plans. The first is a fixed period plan. In this plan, the client's investment is fully paid out over a specific predetermined period, for example, 4 years to fund a university education. The payment amount is calculated each year. So If you have a $100,000 investment and you are wanting to do a fixed period plan to withdraw over 4 years, not accounting for any growth or decline, you would simply withdraw $25,000 a year, which would be the original $100,000. The last plan is the life withdrawal plan. This plan is similar to a fixed period plan, but the time the period is based on the client's expected remaining lifetime, with the goal of paying out the fund completely by life's end. Typically, these life withdrawal plans are associated with insurance products where you might get a payout for life of a fixed amount or a variable amount depending on what type of insurance product you pick. But just know that a life withdrawal plan is similar to a fixed period plan, but the end date and the period itself is not known. It's set up to attempt to match the lifespan of someone. Taxation of mutual funds. Again, when we're talking about mutual funds and being taxed, if a mutual fund is held in a specific type of account, it may not have any tax consequences. For example, if you hold a mutual fund inside of a tax-free savings account, it does not matter what happens to that mutual fund, be it growth or decline, or interest being paid or dividends being paid. It is not taxable, and there are no tax issues or consequences to owning a mutual fund within a tax-free savings account. So what we are talking about from a taxation standpoint of a mutual fund is holding it in what we are calling a non-registered account. So any account that does not have tax shelter. An RSP would be a tax shelter. A tax-free savings account would be a tax shelter. There are many types of tax sheltered plans. As long as a mutual fund is held within that plan, there won't be taxation of the mutual fund itself. So we're in this example now, when we're talking about mutual funds being taxable, it will be holding it inside of a taxable or also called non-registered account. So how are mutual funds taxed if they are taxed? There are two ways. The first would be in annual distributions. The fund distributes its net interest, dividends, and capital gains to unit holders. The investor receives a T3 or T5 slip and must pay tax on this amount, even if it is reinvested. The second would be capital gains on redemption. So the investor personally realizes a capital gain or loss when they sell or redeem their units for a price higher or lower than their adjusted cost base. So again, two types. One can happen where the fund pushes out its interest, dividends, and capital gains to the unit holders to pay tax on. Or two, it can happen by an investor selling a mutual fund for a gain or a loss. Those are the two different ways of taxation on a mutual fund. Adjusted cost base, I used that term in the previous screen. What we mean by that is the adjusted cost base is the most critical calculation for non-registered mutual funds. It's essentially for determining your capital gain when you sell. So if you think about a mutual fund investing $1,000 into a mutual fund that you later sell for $2,000. $1,000 is your initial investment, but there is a calculation that must be done to that initial investment to get your adjusted cost base. You have to calculate for any distributions, any taxation that's already been paid by you that can affect the cost base to either increase or lower the amount of tax you would owe when you go to sell the mutual fund. So quite simply, a capital gain is the proceeds of the sale minus the adjusted cost base. What is the adjusted cost base? The adjusted cost base is not just your original purchase, like the $1,000 I just mentioned. It is the sum of your initial investment plus all reinvested distributions. Every time a distribution is reinvested, it buys new units. It increases your total cost base. So let's look at an example. If we invested $10,000 in a fund and held it for over 5 years, with the fund paying $3,000 in distributions, which you reinvest during this period, You pay tax on this $3,000 each year as those distributions are paid out to you. So your adjusted cost base is now $13,000. It's the initial 10 plus the $3,000 that you have received in distributions. Then you go to sell the fund for $15,000. So the correct capital gain would be the sale amount of $15,000 minus your adjusted cost base, which is $3,000, which gives you the capital gain of $2,000. The incorrect, or the way some logic might be thought of this, is that you sold it for 15, but you only put in 10,000, so your capital gain would be $5,000. That is incorrect because you're failing to track your adjusted cost base by adding the reinvested distributions, which means you could incorrectly pay capital gains tax that you've already paid tax on. That's the end of this chapter. Again, I can't stress enough. Please read the chapter in its entirety. All of the information included in the chapter is testable on your final exam. And we will see you at the next chapter.